Okay, so let's get this all kicked off. Really positive start to the morning session, although DAX just sliding a little bit lower. A few earnings to talk about, I think, just and a positive close to the Shanghai session. It's been another very volatile day in China, and but it's ending on a positive note, as we've managed to track down the Shanghai Composite, ticker symbol SH Comp, and as you can see, closing right on its highs for the day, having been as low as 36.12. So just helping lift sentiment here. The other thing notable, as I discussed yesterday, earnings have started to come in a little bit brighter, and that's why the S&P, I was looking for a bounce. If we just look at the charts yesterday, I was looking for a bounce yesterday before the cash open, and unfortunately got that horrendous dip towards just about that 62 level of support, and then we basically rebounded all the way just shy of R2 on the day. And what's the catalyst for this? Well, firstly, we got good earnings from Pfizer, Ford, and UBS. And just as I was reading in the morning read this morning, they've got some good stats on earnings season thus far. 76% of companies out of the 250 odd companies reported so far have beat earnings. And on the sales side, this is the biggest concern that we have out there in the markets, is if there's no revenue growth, if there's no top line growth, then companies cannot continuing to bash costs and cut down on costs as a means to squeeze out earnings per share beats. So we need to see some revenue growth. And at the moment, markets are sort of liking what they're seeing, I suppose, from a sales perspective. I mean, we're just 50% beats to misses ratio there on top line. So it's not been quite disaster, although, as Piers mentioned yesterday, we've had expectations for this earnings season, at least for top line, come down significantly. But anyway, yesterday's earnings just and very oversold levels in some of these equities, I think were just a good buying opportunity, and as a result, the S&P rallied to its best level, its best day for a couple of weeks, and at the moment looks nicely poised to add to those gains on Fed day today, which we'll discuss later. And the other thing driving equities this morning, although DAX just sliding a little bit lower, we had a raft of earnings. Firstly, Total, the French oil giant, coming out and beating expectations with earnings just 2% lower than they were this time last year. I think we've all seen that crude oil chart enough times to know that we're in a very, very different oil pricing environment than we were this time last year. So that was definitely a welcome surprise for investors. So Total beating Peugeot, the French car manufacturer as well, announcing its first H1 profit since 2011. So also helping sentiment. And also Barclays notably beating earnings. I've been bullish on Barclays for a while, and beating again. And interestingly, looking at some of the research that I've been reading, a lot of research analysts out there, hang on a second, are becoming more incrementally bullish on the financial sector, because it's underperformed for such a long time on the basis of, well, firstly, all the fines and the regulatory hoops that they've had to jump through over the last 4 or 5 years, which look like they're starting to clear, and we might be through that stage for now. And then secondly, if you are entering a period where you get higher interest rates, well, that helps banks because they can make more money on what we call the credit spread. and the spread between their borrowing costs and the amount that they can charge to lend to corporations. So in an interest rate rising environment, you expect financials like Barclays, who have already been through the tough regulatory hurdles, to outperform the wider market. So it's no surprise that a lot of research that I've seen out there has been becoming more bullish on the financial sector. So I've talked about China a little bit, but I tried to get in a fib series. I didn't know exactly where to draw it, but I've drawn it at the point where I think this whole rand pull began, which was November 2014, and that kicked off that massive rally that we saw, which already looked pretty bullish. Pretty strong up to January, but then we had a bit of a pullback, and then, we went all the way to this ridiculous high, and then since then we've kind of bounced between the 61.8 fib and the 38.2 fib as the Chinese state authorities have desperately tried to contain this kind of rampant selling that we've seen, and that, I think, has started to spill over into the wider equity space, into global equity sentiment, and with kind of the shaky start to earnings season, uncertainty over Fed policy and Greece has kind of led to this kind of sticky period for equities. So definitely keep your eye on Shanghai going forward. And in any case, whatever the outcome, even if Chinese stocks manage to rally from here, I think that investor confidence in Chinese stocks has been shattered, and I think it'll take a long time for investors to recover their trust in this what is essentially a state-managed equity rally, the kind of which conspiracy theorists will have a field day. With that in mind, I found a good article on Zero Hedge, just talking about the terrible fallout. Unfortunately, when any bubble bursts, there are victims, and there are always people buying at the top. Just reading out a couple of these quotes. I've lost everything. I don't know what to do. I trusted the government too much. I won't touch stocks again. I have ruined everyone in my family. So some very dramatic stuff. I will sell all my shares tomorrow if there is a chance. I'm pretty sure that if the government does not come to rescue us, the situation will get much worse. So it's quite sad. And I don't think that this is over quite yet in terms of this Chinese stock market meltdown. And also, with that in mind, it's quite interesting to note that a guy called Tom DeMark, who is a well-renowned technical analyst, I'm not a massive fan, but he has yesterday predicted another 14% plunge in the Shanghai Composite, drawing quite interesting parallels. I've discussed this a little bit between the sell-off that we're seeing now in Chinese stock markets and the infamous collapse in 1929 following the Roaring Twenties. So he thinks there's still more to go. Quoting rather ominously, the die has been cast. You just cannot manipulate the market. Fundamentals dictate markets. So we remain very, very cautious with our outlook for Chinese equities, certainly. So let's talk about other markets. Let's talk about oil. Really interesting where we are now. If you can see, this is a daily continuation chart. We're sort of, I mentioned this yesterday afternoon when we got a bit of a bounce. I think we're sort of bumbling along the bottom here. I'd say anywhere between 45 and what the highs of 62, or maybe a little bit higher, 65 is probably the new normal as far as as crude is concerned, I think we're now fairly range bound. And yesterday's rally actually marked the end of the worst sell-off in Brent crude for 5 years, a 6 days severe sell-off in a row. This is a story of many things, of course, but one of the other articles I wanted to share with you guys is one that was sent to me yesterday. Time to rule out a V-shaped recovery with oil prices. A U and a dreaded L remain on the table. So we're not going to get this big ramp back up to the highs on some dramatic sell-off. We're going to now just stay in this range that I've been looking at. And this is quite nice, talking about looking at rig counts. As you can see, looking at the Baker Hughes rig count has basically more than halved in North America overall. So the number of rigs in operation have been removed, but in the past couple of weeks, as oil prices recovered, drillers wheeled out the rigs and have started drilling again, and so that's kind of capping prices to the upside. But I think to the downside, well, I just think it's fairly limited here, just because we've got already we're trading around the lows of the year, and I think that no one was happy with prices where they are, and I just think we're gonna range from here. I think the wider implications of this are, well, firstly, we can say goodbye finally to this commodity super cycle that has been in play since 2002, when China went through its extraordinary growth phase, and kind of bought up all these commodities to fund for their massive infrastructure and urbanization projects. DAX, by the way, guys, DAX just drifting below 11,200 there, so just taking a turn lower. So that early bullishness that we had in equities just giving away a little bit. So DAX just falling a touch, and S&P looks like it wants to drift down to test yesterday's highs around 2089. Just how dramatic has been the fallout in commodities, and by commodities, of course, I don't just mean oil, I mean copper, I mean iron ore, aluminium. Look at this, is the Goldman Sachs Total Return Index, just knocking on its lowest level for 13 years. So as Chinese demand for goods has slowed, as their GDP has slowed, this has hurt so many, it's had very wide-ranging impact. And the news this morning that Brazil have had their outlook cut to negative by Standard & Poor's, so they're currently rated at BBB minus, so they're pretty close to junk status. Brazil, one of the major oil-dependent economies, and has really struggled as oil, as commodity supercycle has kind of drawn to an end here. But I think one of the quite interesting and maybe one of the more significant impacts of this fall in crude has been perhaps its ability to delay the Fed hiking rates this year. Because, okay, I think looking at how the Fed has positioned itself, it's continually said that this inflation, this lower inflation, this disinflation caused by lower oil prices is transitory. But here we are back at the bottom of the range now, and I think this is putting downward pressure on CPI, not core CPI, mind. And it was quite interesting reading this morning that Deutsche Bank are calling for core CPI to rise back above back above 2%, back above the Fed's target later this year. And then when you add in, if say we get crude rallying back to the highs of the year again, when you add that to the overall CPI, I think then you get the Fed in a very difficult position. But I think that when you couple that with yesterday's consumer confidence miss. Consumer confidence yesterday coming in its lowest in 10 months. So this, perhaps that coupled with this dramatic fall off that we've seen in crude once again is going to put downward pressure on inflation and will maybe affect the trajectory and timing of the Fed rate hikes. And this is one of the things we're worried about. But again, I think that we're in danger of focusing too much on the timing and not as much on the trajectory. I don't think that we're going to get anywhere near the type of hikes that perhaps the market is fearing currently. And looking ahead to the statement tonight, well, we'll talk about it later, but I'd expect they'll leave things fairly open-ended and data-dependent. There is no press conference, just a statement, so watch out for their forecast regarding inflation, etc., etc. And don't forget that we do have, until the next meeting after this one, 2 jobs reports and a whole host of other data. Just an interesting correlation to note. Aside from that yen S&P one that I've been banging on about for a while, is looking at crude and T-notes. This makes quite a lot of sense, as you can see. It's a bit of a mess, but generally rising crude prices is causing inflationary expectations to rise, therefore putting downward pressure on T-notes. That is why, if we do get crude rallying back up to the highs, then you should see pressure on T-notes and on the Bund as investors price in higher inflation going forward. Therefore, this will be a problem. This kind of ties in my earlier argument that if crude then rallies up again, say in the third quarter, towards the end of the third quarter, and then by October, November, maybe we've got crude back at $60 a barrel, that would certainly impact inflation and would certainly put pressure on T-notes and further pressure on the Fed to act later this year. But I just wonder whether this recent collapse in crude prices plus the consumer confidence yesterday, maybe we're looking at more like an October or December lift-off for the Fed. But it's just another thing to just bear in mind, that crude T-notes correlation. Quite a good one and perfectly understandable. So let's have a look at the calendar today. Let me just get it up. Well, as you can see, we've got a UK consumer credit and lending and mortgage approval, so a whole host of UK-related data at 9:30. And then it gets all a little bit quiet until we get to pending home sales in the US at 3 o'clock. It's been running fairly hot recently, so I'll be looking for another positive number. And then, of course, the DOE, the Department of Energy, crude oil inventories released at 3:30. I mean, I think that crude has a limited downside from here, so it'll be very interesting to see how it trades around 3:30 after we get this DOE inventories. Of course, a bit of a lottery trading these inventory releases as discovered in recent times. And then, of course, we move ahead to the FOMC later on today. And earnings, so that Fed statement, watch out for that. I believe it's 7 o'clock. We have earnings from Facebook, among others, and Goodyear. So earnings season continuing unabated. My bias for the day is probably in the bullish camp regarding equities, cautiously bullish. Depending on what happens with crude, I think I'm probably on the bearish side of fixed income, and that includes T-notes ahead of the Fed tonight. I think we're going to likely see a data-dependent but probably slightly hawkish start to this statement this evening. by the FOMC. And kind of recent history of the day of Fed meetings is that T-notes tends to come under some pressure. So we'll see how we get on later on today with that Fed statement. Okay, guys, I think that's it from me, more or less. So apart from UK data in half an hour, it's a little bit quiet at the moment. It has been a bit of a summer lull at the moment, but hopefully we can shake things up with this Fed statement later, and then we move into August and September, where maybe volumes will return. So anyway, that's it from me, guys. I hope you have a good day, and I'll be in touch for that session. Thank you.